Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. After a very ordinary 2022, bonds roared back this year with a record amount of money now tracking bond ETFs. We're talking about exchange-traded funds. It's not the only good performer from the last 12 months among the ETFs. Some of the tech ETFs are right up there as well, while ETFs tracking Chinese stocks did poorly along with certain commodities. I wanted to take a look at some of these trends over the last 12 months and what this financial year might look like. Remember, this is general information only. You should seek professional advice before making any investment decisions. Chris Bryke is the founder and CEO of online investment advisor StockSpot, which has released the 2023 StockSpot ETF report. Chris, welcome back to Fear and Greed.
Thank you, Sean. Always good to be on.
Now, I know most of our listeners know, but let's, in case we have new listeners who don't quite understand what an exchange-traded fund is, just the thumbnail sketch of how they work.
Yeah, sure. I'm sure you've always got new listeners. So an ETF is just a wrapper managed fund, or it's something you can buy on the stock exchange. But rather than buying an individual share, an ETF gives you access to hundreds or even thousands of different shares. And so you can buy an ETF to track a different market, like the ASX S&P 200 or the S&P 500 in the US, or it could be a different investment entirely, like government bonds or gold or something like that. So they're just great building blocks for investment portfolios.
Okay, so bond ETFs, I've got to say, slightly ashamed until I thought about it. I always think of equities, I suppose, and then commodities and things like that. Not much about bonds. So people, though, were jumping back into bond ETFs. Just tell us why bonds performed so poorly last year and then what's happened this year.
Well, bond ETFs, I think, haven't been the most popular, and you're probably not the only one that hadn't heard about them before because they had gone under the radar, and definitely global share and Australian share ETFs were all the rage in the last 10 years. Bond ETFs then had a horrible year of performance last year. And the reason for that was that bonds tend to move in the opposite direction of interest rates. And particularly when interest rates are increasing and they're surprising people and increasing faster than expected, bonds do terribly. So last year, a lot of very safe government bonds fell by 10 or 11% for the year, which is quite an unusual year for bonds. It's more common for share markets to have a year like that, but bonds hadn't seen a year like that for about 20 years or so. And this year is a bit of a reverse of that. Now that interest rates are high, bonds are actually paying quite a good yield or return, in the range of 4.5%, or for riskier bonds, closer to 5.5%. And so we're actually seeing the opposite this year. We're seeing a lot of money going into bond ETFs as opposed to leaving money in the bank.
And so a government bond ETF particularly is probably safer than bank deposits, but that's often how people compare them, don't they?
Yeah, I wouldn't say safer, although in the US recently, that's actually been one of the drivers of money going into these sorts of products because a few actual banks have gone belly up and therefore the deposits aren't necessarily safe. Here in Australia, we've got a pretty strong banking system and also some, either explicit or implicit guarantees, particularly behind the large banks by the government. So deposits are pretty safe. Government bonds are also very safe, although their prices vary compared to deposits. So when you put your money on deposit, you earn the interest and the capital part that you put in doesn't change. The difference with bonds is as interest rates go up and down, the actual capital that you put in goes up and down.
Okay. So that's a bond ETF. They're more popular at the moment. You've explained why. What about outside bond ETFs? I think best performing, according to the StockSpot ETF report, were the cryptocurrency ETFs.
Well, that's right. And every year I'd say that it changes which are the best and worst performing. And I don't think listeners should put too much emphasis on it because, this year the best performers were actually some of the worst performers the year before and vice versa. Some of the worst performers this year, including the oil ETF, were the best performers the year before. So these things tend to come and go. But yeah, this year, some of the popular ETFs that had great performance were some of the technology ETFs. And that was because the tech sector had a very bad year last year and had a great comeback over the last, particularly 9 months or so. We saw the Bitcoin and Ethereum ETFs, which were new ones that launched about 18 months ago, actually have a good year. And then some of these ETFs that are related to artificial intelligence and semiconductors and some of the technology that goes into AI also had great performance.
Stay with me, Chris. We'll be back in a minute. I'm speaking to Chris Bryke, CEO of StockSpot. Are people becoming increasingly attracted to ETFs in the current environment or otherwise?
Oh, they absolutely are. So even at the start of the year in Australia, I think there was something like 133 or 135 billion in ETFs. Now that I should point out is massively up from even when I started StockSpot 10 years ago, there was only about 10 billion in ETFs. So they've grown by about 15 times in 10 years, which just shows that how popular they're becoming. But even since the start of the year, Sean, they've grown from 135 to 150 billion. So another $15 billion has gone into them. To put that into context, the Australian share market, the total size is about 1.6 trillion. And so ETFs now make up about 10% of the market size.
It's a big chunk. I mean, the reason I asked the question, you mentioned AI and technology. The thing about ETFs, I suppose, that I like is that it's really hard to pick which AI stock to go for or which individual equity to go for in a trend. And that's kind of where ETFs come into their own, I think.
That's right. I mean, StockSpot focus more on the broad market ETFs that give you access to technology and AI, but also lots of other sectors like resources and banks and telcos. There are, however, a lot more ETFs these days that give you very specific exposure just to one very niche area of the market. They're often known as thematic ETFs. And some of the ones I named before, like there's a Global X FANG ETF and a semiconductor ETF. They're examples of these where they really only buy a basket of shares in a very specific sector. And like you say, the benefit is that rather than just picking an individual share where that company may go well, but it may be one that doesn't go well and goes out of business, you are diversifying and spreading your money across multiple. And you hope that over the long run, the successful ones, stay in that particular ETF and keep on growing. And you accept that some of the ones that are losers will drop out. So you do benefit from that in an ETF. And I think, just as you pointed out, that one of the reasons why people are buying these rather than direct shares is because you can access these themes with a lot less risk than you would have in the past.
Explain what an active ETF is.
Sure. So an active ETF, rather than tracking a market index, like some of the ones I just mentioned earlier, actually is essentially an actively managed fund where a fund manager is trying to pick which stocks should go in and trying to time when to buy and sell them. So you're not just following the market, you're trusting a person to do that for you. Now, historically, active funds were typically accessed in Australia through like a managed fund format, or some of the listeners might have heard of a listed investment company or a LIC. However, there's been a lot of growth over the last few years by funds that have put these sort of structures within an ETF. The big benefit of this is that ETFs are listed on the stock exchange. So rather than having to buy managed funds through a platform or a financial advisor, you can buy them on the ASX. And the other big benefit is compared to listed investment companies, where they often trade at a big discount to what their value is. And so there's a lot of uncertainty. These managed fund ETFs or active ETFs trade very close to their true value all the time. So there's been a lot of these launched. I think at the moment about 17% of all of the ETF money are active ETFs. But based on our research, they tend not to perform that well compared to the index ETFs on average. So there's always going to be a few superstars that do well, but most of these actually perform quite poorly. And that's why most of the money going into ETFs is actually going into these low-cost passive funds, which are the ones that we're recommending to clients.
Okay, so you've said that almost 10% of the market is ETFs. Where do you think it goes from here over the next year to 5 years?
Well, compared to 1% 10 years ago, 10% sounds large, but actually Australia's a long way behind the rest of the world in terms of the adoption of ETFs and passive investing generally. So where we're at 10%, I believe in the US it's something like 25 now. And that's just ETFs. When it comes to passive or index investing, generally it's closer to 50%. So, I think as investors become better and better educated in Australia and continue to see that these products perform better than other products out there, you're just going to continue to see a weight of money moving from direct share picking and active fund managers, which has been the traditional places where people would invest into these ETFs. And, I wouldn't be surprised if in 10 years' time, we've gone from 10 to 25%, which means, hundreds of billions more going into these products.
So just if someone wants to buy an ETF, what are the steps that that they should take, Chris? And if I want to buy one that reflects the market, that's one option. But then if I want to buy one that reflects gold or commodities, how do I go about it?
You've got two options, Sean. So one is you can find an online stockbroker, and there's plenty of them these days, and set up an account and then pick your own ETFs. So there's about 250 listed now, and you can find a list on the ASX website and download it and then try and pick and choose. And if you do that, you've obviously got to work out which assets you want in your portfolio, what percent in each, which products, because even within Australian shares, there's 20 or 30 different ETFs to choose from, and then decide how you manage them. So, that's very popular. It's, I would say, the do-it-yourself option where you pick and choose. The other option is you find someone to do it for you. And these days, there's quite a few services out there that offer that. The business I set up does that, where we try and help people select the right ones and manage them for you, and then do all of the rebalancing and management of that portfolio. So yeah, you can choose either a do-it-yourself or an outsourced option when it comes to managing ETF portfolios.
Chris, thank you for talking to Fear and Greed.
Always a pleasure. Thanks for having me back.
That was Chris Breike, founder and CEO of online investment advisor StockSpot. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.